In this lesson, I'm going to explain to you another way to look at profitability, and that's using something that we call market value ratios. So, have you ever wondered what investors value in a publicly traded company? There's two calculations that can help tell us that. The first is the market to book ratio. So when we talk about market, we're actually talking about the closing stock price of that company on the exchange it's traded on the date that is on the date of the financial statements. So we take that stock price and we're going to divide it by the book value per share. Now, to get book value, we're going to take the common stockholder equity and divide it by the common shares that are outstanding. So what you should be noticing is we're only looking at the common stockholders. And if the company had any preferred stockholders, we're really ignoring that piece in doing these calculations. The second calculation is the price-earnings ratio. Here, again, we're taking that stock price and we're dividing it now by earnings per share. So as a reminder, EPS is net income minus any preferred stock dividends divided by the number of common shares that are outstanding. So let's take a look at what we know about Chicago serial data. So we're looking at year 2. We have a stock price of $52.92. The common shares that are outstanding are 418,000,700. The common stockholder equity is $2,526,000. Now the EPS is already calculated for us, and that is $2.63 per common share of stock. Now let's do these calculations for Chicago serial year 2. So the first thing we need to do is calculate the book value before we can calculate that market to book ratio. Now keep in mind this is only done for common stockholder equity. So we can pull the $2,526,000 right off of Chicago Serial's balance sheet. We're going to divide that by the 418.7 million shares of stock that are outstanding. This results in a $6.03 book value. Now, let's stop here and just think a minute about this number. This amount can be low, and the reason is that on the balance sheet, especially in the assets section, we're using historical cost. It's also impacted by accrual accounting, and it can include management's estimates and assumptions. So, book value, as it's stated here, is most relevant for a financial company, where they have high cash and assets for investing. But when we look at a manufacturer, we're going to have very high fixed costs, meaning that we have very high property, plant, and equipment. Again, that's recorded at historic cost and is reduced by the dollar value in the accumulated depreciation account. Now let's take a look at the market to book ratio. We take the market value of the stock on the date of the financial statements. In this case, it was that $52.92. We're going to divide that by our book value of $6.03. We end up with a ratio of 8.8. Now, what this means is that Chicago Serial is worth 780% more than the amounts that the stockholders have put into the firm. How did we get that 780%? We took that 8.8 number, and we have to subtract 1 from it. That gives us the 780%. Very high number. Next, we have our price-earnings ratio. Again, we're looking at the $52.92, and we're dividing it by the earnings per share, which we know was $2.63. This gives us a ratio of 20.1. Now, this is the investor's assessment of future earnings. So a high PE could indicate that there's good growth opportunity for this company, or that earnings are relatively safe. Both of these would increase the value of the company. Now, when it comes to that PE ratio, we can compare that to an industry average if we know it. Okay, in Chicago cereal, we don't know what that is. We could also compare it to the results of another firm that's in the same industry. So to summarize Chicago cereal's year 2 results, investors are putting a very high value on Chicago cereal. This is indicated by high yields in both that market to book ratio as well as the PE ratio. So what is important for you to remember from this? Again, you need to remember those calculations and be able to interpret those results and give an analysis or an assessment.